Hi class, the purpose of this video is to begin our journey of evaluating financial performance when we look at credit transactions. Specifically, we're going to look at two efficiency indicators: accounts payable turnover and accounts receivable turnover. I hope by the end of this video you understand what I mean by efficiency and how we might use this concept of efficiency to analyze credit transactions and the business performance, and how we're going to analyze, in particular, accounts payable turnover and accounts receivable turnover to analyze our business. So what is efficiency when I use this term? Efficiency is the ability of a business to manage the use of its assets and liabilities, and the ability to use these resources to earn revenue with little waste. And when I talk about assets, what's one of the most important assets that we have? Accounts receivable. And one of the most important liabilities we have is accounts payable. And that's why we're going to have an indicator, so accounts payable turnover and accounts receivable turnover, to analyze how efficiently we're using those assets or liabilities. The strategies to improve efficiency and why it is important, as all businesses want to generate cash as quickly as possible. The quicker you generate cash, the quicker you can pay off all your debts, so address your liquidity, and use that cash to expand your business and run your business. To do this effectively, we are going to effectively and efficiently manage our credit customers, who we know are our accounts receivable. We want to make sure our customers pay their debts as quickly as possible. And to do this, we're going to analyze accounts receivable turnover, and we want this to decrease. We also know effectively managing our suppliers, so our accounts payable, is also really important. We want to ensure we save cash by paying our suppliers as close to the credit terms as possible. So we're going to talk about we want to increase our accounts payable turnover, but not hurt our relationship. We do not want to hurt our relationship. And if you understand these concepts, we want to generate cash as quickly as possible. And to do this, we get our customers to pay their debts quickly. And we maybe don't pay our cash to our suppliers as quickly as we need to, as we can. This will mean we're an efficient business. So what is accounts receivable turnover? Accounts receivable turnover is a financial indicator which has a formula. You're never going to, or very unlikely, particularly in Year 12, be asked to calculate it. You're just going to be given the number. But here's the formula: average accounts receivable times 365 divided by net credit sales plus GST. What's the more important bit is how do we analyze it? Accounts receivable turnover is effectively assessing assesses the effectiveness how effective we are at collecting credit sales of our business. How quick are we, how good are we at collecting the credit sales? How good are we at turning our sales on credit into cash? So an accounts receivable turnover of 35 days, and you'll see that we do measure it in days, means that on average it is taking 35 days for our credit customers to pay us back. Now, is that good or bad? That's hard to tell. But we do have some things that we can look at. What we do want to understand is accounts receivable is measured in number of days, and we want it to decrease. Decreasing is what we call, and this might be a term that you remember, is favourable. So how do we analyse this? What might be good or bad? When evaluating accounts receivable, we look to benchmarks. We're going to look to the credit term. When we sell on credit, we give our customers terms, maybe often 30 days. So are our customers paying us back quicker than what we're giving them, or are they taking much longer? That would be something to look at. We don't want them to be taking much longer than what we've actually set as rules. That suggests our customers are in a bit of financial trouble, or maybe we're selling on credit to customers we shouldn't. We might, and we often look at the trend. So what is our previous results? Is it increasing or decreasing? Maybe what our management expected or what we budgeted for. And these are some terms that you might come across a bit more in Year 12. What might be the reason for this? It might be increased, which is unfavourable, due to these 4 things. And it could decrease or favourably because of these 4 things, 5 things. So maybe have a look at these, try and work out why this factor would increase or decrease your accounts receivable turnover. How do we ultimately reduce it? We come up with some strategies. We better manage our accounts receivable. And these are some of the things that we could do to get our customers to pay us back. We could promise discounts for quick settlement, for quick payment. Now there's a bit of a downside to that. We'll get less cash, but we'll get it quickly. Other ways that give us, which don't involve a discount, would be really promptly invoicing, so sending our bills quickly. Doing extensive credit checks, so making sure we're not selling to customers that can't pay us back. Sending reminder notices, threatening legal action, all the way up to maybe some extreme measures. We might use a debt collection agency or threaten them to not sell on credit again. All of these things will, to a certain degree, most likely reduce our accounts receivable turnover. That will mean we'll get our cash back quicker. What is accounts payable turnover? How quickly we are paying our suppliers. The formula is, and again, we'll unlikely ask you to calculate it, average accounts payable times 365 divided by net credit purchases plus GST. More importantly, what does it analyse? It uses us to evaluate how we're managing our accounts payable. It shows the average time to settle the accounts of our suppliers. How quickly are we settling what we owe to our suppliers? So an accounts payable turnover of 28 days means that on average, it's taking us 28 days to settle our accounts. This is measured in number of days, just like accounts receivable turnover. And this is one that gets a bit more complicated. Increases are favourable, but you can see I've got a different word here, generally. And that means it's not always favourable. It's one we're going to have to analyse. How do we analyse it? We should compare it to our credit terms of our supplier. How long have they given us to pay us back? For us to pay them back, apologies. We often want to extend our account payable turnover rate to ensure that we have cash. We want to make this number often go up, but we don't want to negatively impact our suppliers who give us all our supplies. So we often will look at previous results and management expectations, but typically we want this to be almost exactly at our credit terms. If our suppliers are giving us credit terms of 30 days, there's really no benefit for us to pay them back until that day 30, unless we're getting a discount. So why could this increase, which is generally favourable? These 4 reasons. And why could it decrease? These 4 reasons. And I will again pause the video, try and work out why these factors or reasons would increase or decrease accounts payable turnover. And that is efficiency indicators in terms of what we need to know for Year 11. We want our business to be as efficient as possible so we get more cash. Or not more cash, we get our cash quicker. To do this, we get our credit customers to pay us back quicker, reducing our accounts receivable turnover, and we try and extend how long it takes for us to pay our suppliers, so increase accounts payable turnover, but we're just being a bit careful to make sure we don't annoy them, and that impacts our relationship with our suppliers. Now's the time to use this tool to analyse the efficiency of our business.